Sunday, April 25th. This is Talking About Finance. My name is Dave Coker. And you know the routine. Usually there's 7 slides for 7 days, but we've got so much interesting stuff going on that this week we have 8 slides for 7 days. Just what me and my friends are talking about. Here's an interesting one. This came across a couple days ago, and we're taking a look at mortgage equity withdrawal in the United States. And the center of the chart shows the madness, and I'm using that word intentionally, the madness that we saw in the markets in the run up to the subprime crisis that forced a lot of people out of their homes. An awful lot of people lost their jobs, lost their homes. It just got to be totally out of control. They were treating their homes like ATMs, or cash points as we call them in the UK, and refinancing to pull money out. And once again, guys, you can see we're getting back up to those levels over here on the right-hand side chart of the chart. Here's the thing, guys. Your primary residence, your home, you should be focused on paying that debt down as rapidly as possible. Not using it as some type of piggy bank, ATM, cash point, whatever you want to call it, and pull the money out and spend it, do frivolous stuff with it. I guess it's one thing if you invest it, but even then, there's no surefire investments. Unless, of course, you consider your home an investment, you pay down the debt as quickly as possible. I don't take any pleasure in this, but I'll tell you, during the run-up to the subprime crisis, 2 family members had chastised me for trying to pay down my debt as rapidly as possible. It was the only time in my life I had a mortgage from 2001 to 2009. I was focused on killing it. And I got rid of it in 8 years. But in any case, these 2 family members both told me I wasn't using debt effectively, and I hated it with a passion. I just didn't want to have it. I paid it off. They both lost their homes in that mortgage equity blow up that we had. I don't take any pleasure in it, but just have to report it. So focus on paying down your mortgage. Now, when this came out, I thought, my God, how can people be so dumb? Do they really have such a short memory that they don't recall? And I got some interesting data here. I tried to find an explanation. Of course, this doesn't totally explain it, but it might have something to do with it. And you can see here in terms of financial literacy, very important, just as important as digital literacy is becoming now. And you can see where the US ranks, the UK where I live, and other nations. Now, it's an interesting thing, guys. I can see the attraction in the sense that people might actually think that they're getting something for nothing, essentially, when they, as the commercials in the UK say, let their home pay for it. And they tout it as a cash-free bonus. They use all sorts of deceptive phrasing on these TV commercials to get people to withdraw equity from their home, take out a second mortgage, or not a second mortgage, increase the existing mortgage on their home. It's totally nuts. So please don't fall into that trap. Very curious in terms of financial literacy. We'll talk more about that in later weeks. Bitcoin, once again, got spanked or whacked. And this is an interesting one. This came out about funds going into publicly listed vehicles. Now, I don't really put a lot of stock in this. I don't really think it is as significant as the chart claims, and it's all over social media, so that's why we're talking about it today. Primarily because this is the hot money, and these people tend to put money into lots of different stuff. Money's very cheap and very plentiful these days. And so they tend to chase, it's called yield chasing. They tend to chase or return chasing. They tend to chase wherever they can get the most recent yields, or the most recent yields were reported or returns were reported. So they're moving into Bitcoin through publicly listed funds, and now they're moving out. My crowd, meaning myself and other people, we own Bitcoin, we own other cryptos. We don't really go through exchanges. We certainly don't go through funds. We use what are called non-custodial wallets. Think Trezors, ledgers, those types of devices. We use a non-custodial wallet by peer-to-peer. But still, it's interesting to look at this. And it's interesting to think about where the money came from, where it's going to now. It seems that everyone wants to own shares. And this is from Bank of America, the Global Wealth and Investment Management Group. And you can see their recommendation for shares, new high, my gosh, 64.3% of the assets under management are invested in shares. Shares still burning away. The markets had a little bit of weakness this week on the back of some of Mr. Biden's news, or rumors, really, to be fair to him. So, but still, people want to own shares. It just seems like everybody does. And a lot of that hot money we were talking about, going from asset class to asset class, it definitely flows into shares. when we take a look at shares, I thought we'd look at the FAMs. I don't know how to say that anymore. FANGs was so much better. But when we look at Facebook, Apple, Amazon, Microsoft, and Google, we can see Alphabet, Google as we call it. It's not the real name as listed under now, but we can see when we take a look at Alphabet, this is year to date, up to April 23rd when I created this chart, some 32% return. At the other extreme, we got Netflix down there, and I put Netflix in just to remember a former high flyer. And we can see Netflix is actually falling. What a boneheaded move on Netflix's part. Not only did they raise their fees, their monthly fees, but they did so in a time when there's increased competition. And of course, Disney's the big player now, but it's really interesting to see what Netflix did. They sharply raised, in some cases, their fees, their monthly fee, and competition was increasing rapidly. At the same time, people just voted with their feet. They went other places. So you can see we've got some interesting returns here, though, across the board. And people are still focused on lots of day trading and activities like that, not investing. And that to me is a little disturbing that people don't invest anymore. They tend to just buy and try to flip very quickly. Really what they're doing when they buy and flip like that is they're losing track that it's not the returns you capture, it's the time you're capturing those returns over. And even relatively small returns, 2 to 3% annual, if you have a sufficiently large T, a big time horizon, can turn into substantial sums 20 years, 30 years down the road. Guys, an old Wall Street expression, when asked the question, when's it a good time to invest? The best time to invest was 30 years ago. The second best time is now. Never hesitate from putting money in the market and just hold on. I've got stocks that I've owned almost 30 years. And as long as they deliver, as long as they continue to generate returns, of course, my focus is dividends. But as long as they continue to generate returns, I just hold on to them. Why would I sell them? What am I going to do with the money? I'd have to figure out something to do with the money. But we are seeing a very strange distortion in the markets. And a lot of it has to do, the present strangeness in the market has to do with the wave of liquidity. And here what I've got is M1 and M2. In the words of Peter Drucker, what gets measured gets managed. If you want to manage the money supply, you got to measure it. Although lately it seems people are ignoring the measurements because they're just printing an awful lot of money. And we've got M1 and M2 here. Of course, the US used to track M1, M2, and M3. And post-global financial crisis, they stopped reporting M3. You can still find it. People do synthesize it based upon what we know. But take a look at M1. And that essentially is cash. It's money that's in the hands of people and businesses now. And we can see there's been a huge increase, well over 300, actually 345%, just during 2020. It doesn't show any signs of really contracting. A little bit of a deceleration, but we think it's still expanding very, very rapidly. And M2 expanded, not as dramatically as M1. Now, what does this all translate into? Well, it translates into, a bubble in pricing for lots of different asset classes. We talked about equities. I personally think Bitcoin, even at 49,000 or 64,000, whatever, I think it's a good long-term buy and hold. But this money chases these assets. We see prices get pushed up dramatically across a wide variety of asset classes, not only shares and cryptocurrencies, but look at the bubble that is in the housing market in the States. And it's definitely a bubble with prices really surging. We're seeing it with all sorts of different assets, guys. And the troublesome thing isn't so much that if you put the money into an appropriate asset, and by that I mean tangible, real, physical assets. Think gold, silver, property, and then Bitcoin is, as I always said, for fun. It's not tangible, it's not real, but it's a good investment, I believe, for the long term. But if you put your money in these tangible, real, physical assets, as I mentioned, you'll be okay. You'll have something once the dust settles. Some of these shares are out there in outer space with the valuations, and it's all due to this money that's been printed and distributed, regardless of need. And people do things with money when they get it. Now, here's an interesting one, because we know the money's rippling throughout the system. And I don't care what the media says. I don't care what the Fed says. When I look at the data, I see signs of inflation. And check it out, guys. I'm looking from January 1st 2021 up to the present, I ran this, I'm trying to think, Friday, I think I made this chart. It doesn't really matter when, but soybeans, 16%, copper, 23, corn, 31, gasoline, 42. I didn't cherry pick these. You look at a wide variety of commodities. You're seeing prices surge. Sadly, most people will only pay attention to gasoline, right? And even more sadly, some people will pay attention to soybeans and corn because they won't be able to afford to eat as much as they were eating before. Now, during all of this, guys, we can see Bitcoin up some 73% across the same horizon. You can see the whack that happened to Bitcoin there, a little bit of a sharp correction. But regardless, guys, keep your wits about you. Look at the data. Don't listen to the news so much. Don't listen to me. Run your own charts. You can go to stockcharts.com, duplicate this. You can go to the St. Louis Fed, I should say, Federal Reserve Economic Database from the St. Louis Fed. You can take a look at the Federal Reserve data. You can back into everything I present here. And there's no doubt we're going to see a big, sharp uptick in consumer-facing inflation. It's going to happen sooner rather than later. And I don't drive, but my friends in the States now are telling me that gasoline's getting pretty pricey. It has to, 42% increase there over the short period of time. All right, guys, that's it for this week. I hope you have a safe and profitable week. Go forward and make some money. Hey, I got my first COVID vaccination 1 week ago today. Felt like total crap for a few days. Much, much better now. So have a good week, guys. Make lots of money. Take care.